Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment, and podcast episode today, the first for 2023. It is very popular guest, Andy from Finding Value Finance. YouTube and Twitter details will be in the description, guys. And disclaimer, housekeeping, nothing we say today is to be considered investment or financial advice. It's simply our opinion, our thoughts about what we may or may not be doing. The advice, obviously, is for you and your professional advisor, which we are not. So make sure that is clear. You need to see a financial advisor. We are just sharing our opinions. And with that being said, I'd love to introduce Andy back to the channel. How are you doing, sir?
I'm doing great. Thanks for having me back on. Really appreciate you inviting me back on your channel. So thank you.
Our pleasure. Very well received in our previous episode. And so today we are going to talk about, guys, what has changed over the last quarter. We've seen changes, particularly in interest rates in the United States. And so we're going to talk about that and how that affects sectors throughout global markets. We're going to talk about the recent rise and resilience in the broad index, the S&P 500, and what has surprised us at the start of this year. And we will, of course, be talking about in depth the relationship between the housing and construction cycle, inflation in the economy, and what we expect to see a capital rotation away from bonds and fixed income instruments into the rest of, let's call it the undervalued sector. And of course, it wouldn't be Andy if he didn't share with us some ratios and relative valuations. So we're going to learn from the master today. Yeah, so I thought we'll kick off for a high-level view. Since we last spoke, we looked at where we thought relative valuation was in terms of one sector being overvalued historically compared to another. That seemed to be the case in terms of broad equities and bonds compared to commodities being undervalued. How are you seeing things at the moment from a broad macro perspective?
Yeah, so I don't think anything from a large macro perspective has changed. And obviously I can share kind of the CRB to S&P 500 since we can just go right into it. So this is that ratio that we were talking about, commodity to stock ratio. And we have had a drawdown a little bit in that ratio to the downside, but markets don't move in straight lines. So what they do is they move up, they digest whatever those gains are, they digest, we'll call it interest rates, they digest whatever's in the market and the changing market conditions, and then usually get a sell-off. So the way that I kind of view this is that this is wave one, and then eventually we'll hit a bottom of wave two. And what I'm talking about with these waves is the Elliott wave theory, where markets move in 3 up waves and 2 down waves. So the way that I'm at least viewing this, and it even occurs in ratios, and I already wrote wave 3 over here, not even preparing, but I think wave 3 will come next at some point. Whenever this ratio bottoms, if I were to kind of zoom in on it, we are still working our way down. We have not bottomed yet. We're getting real close though, over time. And we'll hit some sort of bottom here, and then we'll head up into a gigantic wave 3.
That wave 3 normally is the largest move to the upside, correct?
Yeah, so if we were to look at this, let me back out. I like taking the big picture view. Markets move in 3 up waves. So we have wave 1 is an up wave. It pulls back for wave 2. It moves up wave 3, which is the biggest, longest wave of the bull market. We'll pull back in wave 4, and it's usually kind of grind sideways for a little while in wave 4. And it's not as large of a pullback in wave 4 as this pullback is. Then we go into wave 5, which will be a topping pattern or a blow off top. And we can kind of predict somewhat based off of the size of wave 1, what wave 3 could look like. So generally what you do, you can do like a trend-based fib extension. You can kind of go to the bottom here, smack it down, throw it wherever this thing bottoms out at. And generally speaking, if you were to kind of look, waves generally go between 1.618 and 3.618, depending on the market conditions and just how powerful that wave can be, and kind of the tailwinds that it occurs under. And for this ratio, we could go somewhere, 0.015. Well, it also says 0.1015, but somewhere in this general vicinity here for a wave 3. Think of it, if you kind of look to the left too, you look for resistance. There's a lot of resistance in this area as well. So that's probably a good spot that it's probably going to get maybe stuck at. So I'd probably, if I were to wager or take a guess, it's probably going to be somewhere in this range in here, just because of where this previously traded for a little while in history. And again, this is the ratio.
Way for you to estimate, because just to really draw this to listeners' attention, Andy's looking at a longer time frame. I think people have the attention span of about 5 seconds in markets, and they wonder why we haven't seen a mean reversion. So going back to 2007, so 12, nearly 13 years. And so from here, is there any way that you look at in terms of timeframes for some of these fib movements to the upside, or is it just totally dependent on the environment at the time?
Yeah, so it generally runs with the housing starts that you were talking about, which is the market conditions of money or credit coming into the system. Okay. And this generally happens under those conditions. Now, how long will the housing market go up, providing those tailwinds for commodities and headwinds for stocks? If I were to take a guess, it'd probably be between 7 and 10 years, okay, somewhere in that range.
So
maybe it could
like a business or credit cycle historically.
Yeah, so this cycle here, so if we were to look, this was a disinflationary cycle. So if I were to take, and I'll just kind of show you guys real quick, this is one cycle here of a disinflationary cycle, and the length of that cycle there is, roughly speaking, it's 4,200 days. Okay. That's what that recovery, we'll call it, from a peak into a recession into a recovery phase, and that is we'll call it the tailwinds for the S&P 500 and the headwinds for commodities. So that's how long that lasted, was 4,200 days. So one could argue that the potential move coming ahead of us is a similar move, and you can kind of move it forward like this from the bottom, and that puts us out to 2031. If it were to match, the downturn were to match the length of the expansionary phase. Now, that doesn't mean it will last that long. It could be quicker. It depends on how fast we can build the homes, how fast we can catch up the deficits in the housing market. There's obviously, it's not just one or two things. There's a whole bunch of things that can delay it, move it. We had we had COVID, which slowed things down. So there's things that can slow it down. There's just things that can speed it up, depending on interest rates, depending on, I think, certain things, labor shortages, supply chain shortages, all sorts of things can slow this thing down a little bit. But if I were to take a guess, I would guess somewhere between like 7 years is probably a good number. That's the historic length that it takes, is about 7 to 8 years. So that'd be a good conservative bet. Everything structurally is still there for this cycle to continue. Right now, we're just in a pullback. We've had an increasing interest rate environment, and things are slowing down. We've seen a big pullback in the overall markets, and that's kind of where we're at. If I were to compare it to the last bull market, you can kind of compare it to the 2000s. I think we're in that like 2001, 2002 timeframe, where rates come on up, the stock market pulls back, then we'll bottom in the stock market at some point, and I think that everything will go up together at one point.
Okay, and that's interesting because I mentioned we've seen, as far as I'm aware, the fastest acceleration in interest rates from the Fed funds rates over the last, call it half a year to a quarter. And I, for one, certainly expected, with that rising cost of capital and rising discount rates through which companies normally would be valued, we'd expect a sharp decline in the S&P. And yet we've seen the start of the year and the S&P's got a four handle against it. What are your thoughts? How far, do you think the Fed can actually raise that Fed funds rate, given the balance of payment issues that the US may have, or it does have? It's a fairly open secret. And what do we know about the lag time between the Fed hitting that terminal Fed funds rate and that being reflected in the stock market, taking that dip that we've been waiting for, and yet so far in February, we're yet to see it?
I think the Fed's in a tough spot because they're going to create inflation no matter what they do to some extent, because you're getting inflation either from the real estate market, or if interest rates go up like they have been, they're going to get inflation from, we'll call it the interest on the debt rolling over, and they're going to have to probably do deficit spending to cover that. So they're in a difficult position where if they try to hold rates lower, which means they I don't know, save some companies that have high exposure to bonds or whatever the reason is, they're going to have to print money, which is inflationary, to hold interest rates down. Now, if there's a problem in the bond market, what you're going to see is you're going to see interest rates take off if there's a problem. Mm-hmm. So let's say they're not doing QE. Let's say they're like, okay, we're not going to do QE. We're not going to buy anything. And let's say the market really doesn't want to buy bonds. There's a true problem in the market. You're going to see interest rates spike. And if you see interest rates spike, I think the stock market's going to eat it pretty bad, because if they lose control of the bond market at some point, you could see interest rates spike up, and then that stock market's going to have to digest those higher increased interest rates. And looking at and I'll share here real quick what the 10-year yield looks like. This is the 10-year yield. It looks it looks pretty aggressive. So this is, if we were to just take a big picture view, this is a rising interest rate environment from the peak here. This is a declining interest rate environment, and we've broken the downtrend of that long-term, over about 40 plus years downtrend in interest rates. And if we look at to the right-hand side, you can see there's a lot of, we'll call it upward pressure on yields. So yields going up means that there's selling pressure in bonds. People are dumping bonds and yields go higher to attract more new buyers. Now, what happens is if the currency isn't used around the world for a variety of reasons, like let's say they're not going to do purchases for oil and other commodities in dollars, there's no reason for people to cycle dollars back into bonds. So there could be a mass exodus out of bonds at some point, and I don't know what that point is. I know a lot of people speculate on it. I'm not sitting here trying to claim I know what the future holds, but what I do look for are patterns and things in the trends of where they're moving. I'm not trying to predict any sort of outcome. But the way that I'm viewing this, we've got here, like, we're just barely breaking out on the 10-year yield right now with a nice little, we call this a bullish engulfing, where it engulfs the candlestick before it, which is generally a bullish formation. And you can see that we've got a lot of yields moving up pressure. It's selling pressure in the bond market because we're looking at yields. We see a lot of selling pressure in the bond market where yields want to take off here. So it's very interesting to see this, and maybe we get a big run out of this thing where yields actually run higher, contrary to what maybe most people are thinking. We've had a nice little kind of pullback here in yields, and that was a tailwind for the stock market, and the stock market kind of broke up to the upside. But looking at the 10-year yield here, to me, it looks like it wants to go higher. And one of the drivers of the 10-year yield and yields moving up is the price of oil. And we recently saw a breakout of the price of oil, crude oil. We can look at that together, of its downtrend too. So it had basically the same pattern as yields to some extent. Mm-hmm. We've come on back and we are breaking that to the upside here. So there's our breakout. This first circle is the breakout, and then we did a return move. And now we're starting to work our way higher. It's going to grind on up, I think. And if I were to say, how would I compare crude oil to the 10-year yield? I can do an overlay real quick so you guys can see it. They look very similar. I'll just say that they move very similarly. So that's kind of the similarity. The orange line is the 10-year yield. The candles is crude oil. And you can see that there's a relationship there where they're very highly correlated. I mean, it's not perfect, but they are correlated. And what I'm seeing here, if I were to kind of this is the 10-year yield. You can see it kind of just breaking out there, and it's usually lagged behind oil. You can see that there's similar patterns here.
And that's what I wanted to ask, because I mean, if you think logically, well, oil is an inelastic demand for energy needs and transport needs around the world. And so when oil starts to rise, people start to say, and that's a lead indicator or a heavy component of the CPI and inflation. So people say, well, I'm getting this fixed income instrument that's at 3.68, let's call it at the moment, but the inflation rate, the CPI being driven by oil, let's say, is at any number higher than that, 5, 6, call it what you will. And so people are having a real loss on a real basis. And so that tends to make sense that people will move capital away from the bond market into real goods and services because they have to keep pace with the inflation. And so does the Fed allow that to happen and we see this capital rotation inflating commodities, or do they step in and somehow try and reverse course, which will mean a lower cost of capital, and people will move capital into these speculative risk assets, creating inflation in the stock market? So it's an interesting dilemma that they have. And yeah, what are your thoughts around that? Do you believe that it's mainly oil that's the dog wagging the tail, and then you see it as that?
Yeah, so I think oil is the translator of inflation into goods and services. Mm-hmm. So that's the intermediary. And if there's any sort of problem with oil, that's where you're going to see that inflation in the consumer price index. So they measure inflation through the consumer price index. The consumer price index, it's got housing, it's got a bunch of things that, it has energy in it as well, it has food, but all of the other things is basically food is a translation or derivative of energy, and products is a derivative of energy. So ultimately, the majority of that is just a derivative of energy, if that makes sense. So food prices is more or less an extension of energy prices, because energy prices is more or less the price of fertilizer, the price to grab and the diesel prices and all that other stuff. So the reason oil is the number one commodity, well, it is the number one commodity. It's also very inflation sensitive because it is the inflation. That's kind of how I look at it. So that the money that comes into the system, credit expansion is what I talk about, the thesis of the housing market and the real estate cycle and the business cycle. That's the money coming and credit coming into the system, which puts everything into a shortage. Oil, being the number one inflation sensitive commodity, sees that credit or that expansion and puts oil basically into a shortage. And if oil can't grow, if it can't grow at a fast rate, if they can't grow production or supply very quickly, then you're going to see oil prices really start to move on up. So what the government did and what the Federal Reserve did, or maybe they were doing it, in tandem, is when we had a constraint in oil, they released from the Strategic Petroleum Reserve to cool inflation from that aspect. Mm-hmm. So they basically said, put it out in the market, cool it all down. That's one way that they could manage the inflation to some extent and control it. I don't think they can do much from a interest rate perspective. I mean, yeah, you can raise rates up to some degree, but they can't control or necessarily fix a supply problem in oil.
And this is the issue. Yeah. I mean, you can tinker with monetary and fiscal policy all you want, unless you are bringing more of supply units onto the market that are in demand. Well, then you're always going to end up in the same position. So you can put a band-aid on things through releasing the SPR. And again, when the economy starts to tank on the back of rising interest rates, and the Fed steps in to buy up the bonds to lower those rates, well, now it becomes more attractive for real estate cycles, right? Because your cost of capital decreases, and we're back into that same cycle about which you've been talking.
Yes,
it's super interesting.
definitely.
You mentioned obviously energy being the key input into urea and nitrogen and different bases for fertilizer. We've seen natural gas prices fall off a cliff recently. Everyone was freaking out about the war in Ukraine creating supply squeezes, and now with Europe having a freakishly warm winter, it seems as though they've got their natural gas stock, at least for now. Are you finding gas attractive as a relative bet to oil? So as a massive oil bull, I'm starting to look at natural gas and saying, gee, if we get close to to the 2 line, it'd be pretty hard not to have a look at it, right?
Natural gas looks amazing. So yeah. So you're dead on. So let's take a look at natural gas and a ratio of crude oil to natural gas. So this is crude oil. This is natural gas. And we're all the way up at 31.69. So here's a long-term kind of chart on it. There's been historical anomalies. 48 is just a ridiculously cheap area. We're at 31 point. I should probably update this price thing, but we're at 31.69 is where the current price is. That is incredibly cheap, like incredibly cheap compared to history. If you were to look at the energy content of natural gas in relationship to oil, the price should be around 1 to 6. That's kind of the energy content equivalent. Oil carries generally a little bit of a premium because of its how easy it can transport and move it. Natural gas, yeah, it's a little bit on the cheaper end of a 1 to 6 ratio, generally speaking. That's kind of where this line is, around 10.
You need the infrastructure to turn it into LNG and then run it through a pipeline and so on and so forth. Whereas oil is a little easier to just chuck it in a barrel, so to speak.
Yes. So it usually carries a little bit of a premium, but up here at 31.65, it is incredibly cheap for natural gas. And generally speaking, the way that you make money is you want to find what is cheap, and it's got a lot of momentum behind this move. If I were to look at natural gas priced in dollars, we've had a pretty big fallout because of weather related stuff around the world, with very warm weather. If you have a partially filled inventory, and this is to deal with the transportability and all this stuff with natural gas. If you don't draw down your inventory, what happens is you have to stop shipments of natural gas. I mean, you literally are going to say, guys, we don't need any more, like shut it off. And it's kind of hard to do that because you're going to run out of storage of natural gas if you don't draw it down during those winter months. And we've had a very warm weather over in Europe. So their inventories are still somewhat high, but people are looking at it and saying, well, maybe the rest of the winter we're not going to draw down. So they're getting scared. So the prices are falling off a cliff right now. So that's in my opinion, I would wait for a clear bottom. It's still looking pretty momentum-ish coming back. Wait for that momentum to dissipate. Usually you get a couple of sideways movements. Then I would say ultra bullish, ultra bullish on natural gas, because natural gas, I mean, we are moving everything to natural gas. It seems like we are decommissioning coal for natural gas plants in America. Natural gas also, the first half of them filling up their inventory was based off Russian natural gas. Europe's for last, this winter that we're going through. They're not going to have that coming up for next winter. So it highly depends on how much natural gas they use between now and next winter and how we're going to basically replenish their inventory. And if natural gas prices get low enough, they're going to start shutting off natural gas, which then is going to whipsaw it again in the future. So it's just this one big gigantic whipsaw back and forth. The one thing that I thought was really cool here is this is setting up a Jesse Livermore cylinder, which was 1, 2, 3, 4, 5, 6, and then I thought we were gonna bottom somewhere around 4.5 or 4, somewhere in this range, but it looks like we're going all the way down. I think it's an excellent spot to be looking. I don't know if I'd be buying this second, but I would be watching it like a hawk because this is one of the cheapest commodities at this time in relationship to a bunch of other commodities and assets out there. So natural gas, let's kill it. Yeah.
Yeah, absolutely. When you've seen during that amazing chart, there's really only been two other times in history where relative to oil, we've been at these kinds of relative valuations. And that's super interesting. It's recently, some of the coal barons on Twitter have been very upset with coal price movements. Are you of the opinion that we've seen a recent sell-off in some of that thermal coal because natural gas now starts to look so cheap and people are thinking that most of the thermal needs will be supplied by nat gas? Or is it simply a case that those coal futures were so damn high over the last 12 months or so that they were due for a pullback? Be interested to get your thoughts.
Yeah, so Newcastle Coal, that's the one that I follow here. So generally what happens is you kind of break out and you get a return move, but this has gone up quite a bit in a very short period of time. So I would say this got pretty overheated and I think it's just starting to cool off. And I also think natural gas is having an impact. With natural gas prices falling down, I think it's pulling down coal futures as well. But I do think that we are still in an energy crisis. And I think it's dangerous of what's happening right now. And what I mean by that is everyone is basically saying like, oh, everything's okay. So they made it through one winter. They think everything's okay, just kind of the general market and the general opinions. Everybody's like, oh, that's so last year, so to speak. I don't think any of the problems have been solved. So all of the conditions are there. They're all sitting there. And now, and this could be like I'll just say this. I think this is like a gift to investors. So if you look at it from a longer term perspective, instead of, I see price movements on a day-to-day basis or a month-to-month basis, if you take a big picture view, natural gas could be just one heck of a deal at one point over the next few months. And I think that's a gigantic opportunity, like just gigantic, because what happens if the sentiment goes from, oh, we've got too much natural gas. We don't know where to put it. The inventory is full. We don't know what to do with it. And then that rotates where they have a one cold winter and they're like, crap, we're going to run out. Sentiment goes to the opposite end and the thing just rockets like it did before. Absolutely. So that's where you get all of the money, is if you take the complete opposite bet as everyone else, and have a time frame that's long enough where it's like, oh, I'll just wait them out until the market conditions change and we get a cold winter over and up. And if they get one cold winter and the inventories drop, it's like, boom.
Especially considering they can't go back to where they previously got that gas through the Nord Stream pipeline because that ain't there anymore, guys. And natural gas is not, it's not a global market like the price of WTI for oil. So it was so interesting to see the dynamics play out last year, where you had Henry Hub rose a little bit, but not so much because the US could keep natural gas within for their needs. But Europe, you saw Dutch TTF futures just fly off the handle. And I think it would be an interesting way to play it. And I agree. I mean, one winter, you're going to basically run through your inventory, and that needs to be refilled because the Europeans have basically committed energy suicide. They got very few nuclear reactors. They seem to hate coal. So nat gas is what they rely on. And if your old pal that used to sell you the natural gas is no longer, well, they're literally not allowed to sell you the gas. They can't move it through the pipeline. Yeah.
I think next winter is going to be more difficult for them than this winter because they had the Russian pipeline. Everything was flowing in the beginning. They kind of filled it up. It's a flow rate problem. It's not an inventory. You can fill the inventory up, but then it becomes a flow rate problem, and it's highly dependent on weather. If the weather's warm, I mean, it's like you kind of lost if your natural gas bet. It doesn't pan out the way you want it to. If it's really cold, boom. And natural gas is not we'll just say it's one of the most volatile commodities out there. They call it the widowmaker because if you get caught on the wrong end and you get weather, it really wants to just fall out. But conversely, on the upside, it does the same thing. So we are literally
stay away from leveraged instruments on natural gas, you degenerates listening to this.
It's one of the most volatile commodities, and man, if you get it right and you're on the right side, you can make a lot of money very quickly. And so really what you want to do is you want to look to see, what's your risk reward? How can you handle that? What do the companies look like? I go through the companies, I don't play it directly. And the companies do hedge. They do kind of, I'll say, soften the blow to some extent, because they put hedges in place. Some of them, they hedge 50% of their production, the other 50 is floating or something like that. Other companies don't have really anything hedged, so they're gonna move a lot more freely. So I think natural gas coming at some point. This could be like the biggest setup ever, because if we've had the Freeport LNG terminal down for a long time, basically this whole winter, and if that comes back online, and I know these are ifs, but if that comes back online, and it should soon, and more LNG terminals come online, it's going to connect Henry Hub to international pricing. And dependent on weather, it is out of our control. If we see a cold winter next winter, I think we're going to see a really good opportunity here in the next 3-6 months, something like that.
And you mentioned you're playing it through companies, and I won't ask you to name specific companies because I know that's part of the membership service that you offer the platinum members. But am I right in thinking that these companies are probably in a better position now than they were pre-COVID due to their balance sheet? Their balance sheets should be much better given the cash they've been earning. They should have less debt on the balance sheet, and they should be ready to, like you said, that risk reward ratio should be skewed in your favor now, because I know during COVID, people were worried that they were going to go bankrupt, and they just, like the Ontario Resources of the world, just hit rock bottom valuations. But now the balance sheets are kind of better. So even if they have this sort of one bad year of selling at low prices, they should be robust enough to be able to see things through until, if and when this event that we're expecting occurs. Is that a fair comment, or you think that they've kind of about the same?
So I was very brave and bought the 2020 bottom when everything, like everybody was selling it. Nobody wanted it. Kathy Wood was coming out saying that oil was never going to go over $30 a barrel again and all this other stuff. And I was like, this is perfect. I love this. That's where I really kind of loaded up in a lot of the companies. Now, yeah, the balance sheets are like 1,000 times better than 2020. You wouldn't even like know that they're the same company, and their revenues are just ridiculous. A lot of the companies produce natural gas and oil. Oil is still pretty robust, so they're doing very well. And that's why I don't think they're going to fall down as much as what maybe some people think. And from a risk reward standpoint, they are still looking very good. Of the exploration production companies, the energy service companies look really good too. So both those sectors, they look like on fire. Now, I would say energy service does look cheaper in relationship to the exploration production companies. But if natural gas stays down here for a little while and some of the companies kind of pull back some, I think that's going to look really good too. They're going to make a lot of money if this were to reverse into where natural gas could potentially trade if we get into kind of a squeeze type scenario in a year or two. But right now, I mean, the weather, it's going to take a little bit of time. I think it's not going to be a quick trade.
No,
in natural gas.
But I don't think it'll be a particularly long time to wait either. I mean, winter comes around once a year, right? And that's going to be your catalyst to drive down those inventories. I want to make one more comment on natural gas, and I'm going to lead straight into transport, because you got to move natural gas from Freeport to Europe potentially via ships. And I want to talk to you about that. Not recently, towards the end of last year, Go Rosen have been talking a lot about this idea that you mentioned, that Henry Hub would match up with the rest of world pricing. And at the time the research article was published, that would have suggested Henry Hub move from around the $5 mark towards over $30 potentially. Currently, that would suggest maybe a 10x on the natural gas futures. So you think about a 10x on the commodity itself, and then you have the leverage of an explorer producer on top of that. I mean, we could potentially see some massive right tail movement. So I just thought that might be an interesting thing for people to keep an eye on.
Totally agree. It's going to be, it could be a very, very big move in the natural gas producers, because some of these producers, they're leveraged a good amount in relationship to the natural gas commodity itself. So it could be 2 or 3 times leverage to whatever the natural gas price does, depending on how much they're hedged. So they can hedge a certain portion of their production, which basically they'll lose money on those derivatives if they hedge. Some of the natural gas companies are almost completely exposed to whatever the natural gas price does. So then it's the difference between their costs and what the natural gas price moves. The best scenario, if you want to try to time it or whatever, is if natural gas prices come back to the cost curve of the natural gas producers, they pull on back. And the ones that pull back the production, the higher cost producers, those will be the ones that make a bunch of money when it reverses back to a higher price. So it's the ones that are turning on and off their production.
Okay. And your estimate is to cost of production for natural gas, where'd you say like the average?
It's probably
for break even.
Well, it depends on the fields. I think a lot of the fields are between like $1.50 to $3, somewhere in that range.
Okay, so it's quite a range depending on where they are.
Yeah, so really cheap.
You be like shale plays.
Yep.
Yeah.
Are the higher cost producers. Yep.
Okay.
So depending on where they are and what shale plays and what areas, some of them are cheap and some of them are more expensive. And the ones that are more expensive are going to be a lot more volatile to the price moves, because they're going to make less money as it goes down, but they're going to make an amplified move when it moves up, because I'll just make up, let's say natural gas is $3 and their cost curve is $3. They make zero money at $3 natural gas. So the company's not making any money. But if it goes to $4, well, if you're not making any money and that now they're making $1, what kind of return does that have? It's an infinite amount of return if you're making nothing to $1, $1 of profit. But what if you go from zero
multiple to those newly realized cash flows, and it's a levered effect.
Yes, it's huge. And if you go from zero to let's say they're making $10 a million cubic foot, oh man, they're going to go ballistic to the upside. But you have to kind of just wait and see which ones and see how far they fall. And if you got a good entry point and they put a pattern in place, I mean, there's your opportunity. It's coming.
No, we'll be keeping an eye on it. That's the beauty of these recorded conversations, is we can see how things play out over time. Mm-hmm. Now, shipping, particularly transport, because shipping has killed me over the last year. I've been mainly not in tankers. I started in tankers and sold out too early before I realized most of the games. What are your thoughts on shipping in general at the moment, but then particularly considering this theme that we're segueing into, transporting of energy, particularly natural gas? Do you like shipping at the moment, or you still think that we're going to need to be later on into this cycle before we're moving, or before we're going to see demand for dry bulk and containers come back to close to where we were?
Yes, I don't really follow container ships too much. I usually look at the dry bulk, kind of Baltic Dry Index and all that. I think dry bulk is like cheap as all get out. Like it is. If you were to look at, natural gas is cheap, Baltic Dry Index is cheap. Like those are rock bottom prices. And I can understand dry bulk shipping, because you've got a lot of ships, they have a lot of embedded energy into it. So if energy gets very expensive, it's going to be very hard to replicate those ships at a cheap price. And especially if you get tightness in the commodity markets too, because they use a lot of commodities to build those ships. And if you look towards the future, the vision for the majority of, I'll say, world leaders is electric vehicles, renewable energy, all these different things, and they're all mineral intensive. So if they're 16 times more mineral intensive to build these things than your other energy sources, what does that mean? It means you have to mine more materials and ship more materials. So if they really, let's say we get in an energy constraint and they push the renewable electric vehicle and they just say flat out build as much as you can. Basically what they're saying is mine as much material as you can. And I think the choke point is the shipping. I think the shippers are just going to make a buttload of money.
Because you've got to get these minerals, materials to the manufacturing facilities from the production sites, which are, Africa mainly and wherever else. And you've only got a decaying fleet that's been decimated over the last decade or so. And shipyards are already at their capacity. There's not going to be any real excess supply or capacity fleet coming online until I think 24, 25, depending on where you look. So yeah, you could well be on the money there, that it's just going to be this bottleneck, and maybe it's not the minerals the way to play it. It could be the, buy a ticket to the toll booth.
Yeah. So I think the shipping companies are the choke point, and I think they're the ones that are going to make a ton of money. If you look at historical figures, the Baltic Dry Index, and I can show you guys what that looks like here real quick. I'll just kind of bring up the Baltic Dry Index.
Let's take a peep.
So the Baltic Dry Index is here, and it is way, way cheap down here. And if I were to throw, let's just say crude oil on top of this, it's kind of interesting. Hopefully I didn't shut that out too quickly. So there's crude oil, and you can see that they're kind of linked together. When crude oil goes up, so does the Baltic Dry Index. The Baltic Dry Index is the candlesticks, the orange lines, the crude oil. So if I were to kind of move in here, I'll just kind of like zoom in on it. You can see how this is all, they kind of move together to some extent. And then they kind of crash at the same time as well. So I think, looking at interest rates, looking at crude oil, looking at the Baltic Dry Index, I think everything's lining up for a potential move to the upside for crude oil, which makes me think that the Baltic Dry Index, which has a declining wedge pattern, we're right there at the tip at a very cheap price. I think these dry bulk shipping companies look very attractive. And they're the index is very, very cheap. So this could be another way to play the commodity bull market, because at least the way that I'm kind of looking at it, there's these new emission standards for a lot of these ships. So they're very reluctant to build new ships because they don't know exactly what is going to happen with the emissions on them. And they don't want to dump a bunch of money in it if they don't know, how long this ship's going to last if the emissions are bad on a new one that they build and it doesn't meet the emission standards. So everyone's been kind of holding off on it. And I'm just looking at this like, if we go into a large commodity bull market where we want to build all these, renewables and all this other stuff with that much more mineral intensity, I think this is the choke point, in my opinion, or it could be the choke point. And if it is the choke point, I mean, this is going to go ballistic, and it's cheap.
Yeah, and it makes a lot of sense. And it's almost like these new governmental ESG or environment, at least, standards around like the scrubbers and sulfate emissions that are extremely regulated. It's almost like it's increasing the barriers to entry for competition. And so if you're positioned in a decent shipper, it's almost like these guys are protecting the investment in a very strange sort of way. Because as you mentioned, for those factors, it's hard for another company to come in and start to increase the supply of the fleet. And so you have this choke point of the limited amount of vessels that can move the required minerals from point A to point B.
Yeah, it's labor shortages too, because I don't think they've been building these things for a long time. So it's a whole bunch of things that are kind of culminating into one kind of gigantic tip. And if they said, go build a bunch of ships, I don't think they can. Like, I don't think they can get the capacity up that quick and then just flood the market or anything like that. So I think it's a protected investment or a moat sitting around this area, much like it is for oil and natural gas, because they don't want to be drilling for oil and natural gas either. And ESG and all these other things where investment's not really going into it. I think they're just setting up the most gigantic bull market in oil, natural gas, Baltic Dry Index, like all these different sectors where, I mean, we could see some big moves.
Yeah, it's so ironic because it's the sector that they appear to hate the most, and yet, particularly with the shipping, that, as you said, they're creating a moat around the suppliers, and yet they're force feeding demand from the other end. So you have this pressure on both sides. That it seems more likely than not, to me anyway, that it's going to move to the upside. Now, it's touching on demographics and housing starts. there's just, I think that the people generally have a simplistic way of looking at supply and demand for real estate with an increasing cost of capital that limits the amount of demand that can move into the market. But and I expect that in Australia, for instance, I've sold all my real estate because we cannot fix interest rates like you guys can in the US for say 25, 30 years. So have you been surprised at the moves in the real estate sector, particularly like home and construction stocks? Or do you think that this is playing out more or less exactly as you expected in terms of there's such a deficit in terms of housing needs in the US that it's just a matter of time before we need to increase the supply? Where we at?
Yeah, so there's a big deficit out in the housing market. It's estimated between 3 and 6 million homes to be a shortage. So basically families have gathered faster than they've built homes. We had a massive underbuilding in the early 2010s. So this is the housing starts for the United States. It's right here. Just to show everybody what I'm kind of talking about here, we'll go for kind of a long term. These are the bull markets, or these guys that I put with the circles. Those are commodity bull markets. And you can see these large expansionary phases of real estate that happened where the commodity market was cheap and we got the market conditions right. And then money started to flow into it. So we have a large shortage of homes in the system. We went into this big recovery phase. Now, what I'm talking about is this area under the curve here. So you can see the area under these curves. They're really not that big historically looking backwards. So this area, so the area under the curve, take this line here, going across that white line. If you were to shade in this area, that's the deficit that basically created an underbuild scenario about the average. But if you look at this is a massive deficit of underbuilding that we had in the market.
It's huge.
And it's massive. We've never seen this type of underbuild before. So what I am surprised with in the market that's coming up, I thought we would have more of a stronger momentum trajectory to the upside and more sustaining than what we've had. I've been quite surprised at the interest rates move, how high and how fast it moved, and then how impactful it's been on the real estate market. With such a large deficit, what you're trying to basically think of is affordability is a problem for some of these buyers. It's not a problem for other buyers. So when you look at it, you're already pricing people out of the market with the house prices moving on up. Interest rates shot up like a madman for mortgage rates in America. They went up like 150% or something like that, maybe a little bit more. And what it did is it kind of slowed down the market. And what it actually did is that, people were getting priced out anyway. The affordability is getting worse because you have to price more people out of the housing market. And as we were pricing people out, I didn't know where that choke point would be where people could afford a home, but we're actually going to get priced out. So we're not pricing out. I'll just put it this way. If you have 100% of buyers, what happens is home prices move up to price out certain portions of the buyers because there's just not enough homes out there. As the interest rates go up, you're still pricing people out. The affordability is getting worse, but you don't know if you're actually pricing out potential buyers or not, where the sales would actually fall. So the rates would have to go to a level where you're actually pricing out maybe the top 25 percentile of buyer to price them out of the market, because the bottom 75 is priced out already.
Yeah.
Because they're all competing for the same homes. Sure. So I was a little bit surprised at the slowness or the impact of the interest rates and how high the interest rates got. I was thinking we were going to hit 4 or 5%, and that's where it was going to kind of slow down. But we went to like 7%. And I was like, wow, I didn't think we were going to hit 7%.
And are you talking about a 30-year mortgage?
A 7% 30-year fixed rate mortgage in America. And we were coming off of, 2.75, 2.65, I think is where it bottomed. And we went like straight to 7. I was like, oh my God, that's a pretty quick, move in a year time span or so. And I knew it was going to have an affordability impact. I mean, that's kind of obvious. I just didn't know what the impact would be for pricing out potential buyers and really to reduce sales. We were also coming into seasonality. There's seasonality in the real estate cycle. Or I should say like the real small cycles. Each year you get a run up from like January to like July. And that's kind of like the real estate kind of run up there. And then it kind of cools off a little bit and then tails off and comes down into December. So we've been in the weakest part of the real estate cycle from a yearly perspective. Things cool down towards the end of the year, and everyone's talking about a real estate bubble. It's peaking and all that stuff. So what I'm waiting to see is the real estate market going to kick back on? How weak is it going to stay? Are we in the mid-cycle kind of wobble, and then we'll start to move on higher later on? I do think that we are at a pivot point where interest rates are impacting potential buyers from a higher, we'll call it a higher percent pool of buyers. So if you have 100 homes and you've got 1,000 buyers, and the natural tendency of the markets to price out, let's say 250 of the buyers are priced out from home prices increasing at a fixed interest rate level. I'm just trying to make an example here.
Yep.
So your pool shrinks from 1,000 to 250, but you still only have 100 homes to buy. But I think what's happening is the interest rates have gone to a level where you might only have 70 buyers, but 100 homes. So the interest rate is having an impact on the potential buyers. And now your homes, you might have more homes than potential buyers based off of the interest rate and the home price and the affordability of it. So now we're basically dialing the entire real estate market up and down through the interest rate out there, I think. But we'll see. We're coming into the strong portion of the real estate market seasonality wise, and we'll see how that impacts it. We've seen a kick up in the real estate market in terms of mortgage demand and applications. That has kicked up. We are seeing increased home sales for January, but it is pretty, it's a short little time frame that we're seeing this. I want to see how sustainable it is, what it looks like this summer. I really want to see what this year looks like in terms of home prices, inventory, new sales, housing starts, all that stuff.
Yeah, I think I think you nailed it. It's going to be super interesting to see. And my money is on, well, not my money. I'm not really invested in the US housing sector, but if I had to take a guess, whereas you were saying previously you had buyers that couldn't buy because there weren't enough homes. And now it's more the case of, well, those buyers can't buy due to interest rates as opposed to the number of available homes. And then eventually there's a kind of a floor, at least. I think people are expecting a crash like 2008 because they've got PTSD. But if you fixed in your rates, there's not really servicing pressure. And as long as there's not servicing pressure on your monthly mortgage, you're unlikely to see forced sellers. And you might just have this little cushion of where you go from that 30 homes oversupply in our example to, okay, it tightens again, and then you see the prices come back up. And I think it'd be interesting to see how it plays out. And so you're still bullish on home and construction?
Yes, I'm still bullish until I see a clear break and it just kind of rolls over. I will remain a bull until that happens, and it hasn't happened yet. And I think that the human psychology needs to change a little bit too, because I think a lot of people think, oh, I'll just wait until interest rates come back down. Oh, I'll just wait until the house prices come back down, or a combination of those two things. When the realization sets in that might not happen for a long time, people might say, screw it, I'm going to buy anyway, and start going back into the market. Because I know a lot of people, not just a couple, a lot are waiting for that either an interest rate coming back down and or home prices to come back down. Problem is, there's too many people waiting on the sidelines, and there's not that many homes for sale.
And that's a big issue. Yeah. Until you get this oversupply and forced selling, I think it's unlikely you'll see any kind of really precipitous sell-off. In Australia, it could be the other way. I don't know, but it'll be interesting to see how it plays out. And then talking about precious metals, I know you've been a keen follower of platinum recently in evaluations. Where do they fit in to some of the things we've spoken about? So we've come from top down, commodities versus fixed income and stocks in general. Then we've talked about the energy sector, transport for the energy sector, and now the precious metals. Where are we at in terms of precious metals? Where do you rank them in comparison to some of the other things we've spoken about tonight?
And when you mean by rank, you mean like the total return, or do you mean like the valuation?
I think the valuation, like if I gave you 10 grand today, are you going to put it into precious metals versus housing versus shipping versus energy? Where would you look to first, let's say?
Yeah, so that's highly dependent on your situation. So I don't need 10 grand. So what I would do myself is I would split it up amongst some of these cheapest sectors like Baltic Dry Index, natural gas, and I like
So
platinum.
key point would be sort of what ratio where would you weight most of that excess capital? Because that'll tell us where your heart truly lies, Andy, in the space.
Well, I can tell you what I've already done. So
that's even
I own a lot of physical precious metals. It's roughly maybe 20 something % of my net worth is in physical precious metals. And the reason I view that is because I think precious metals are the least risk asset in the world. Bonds carry more risk, currencies carry more risk, everything carries more risk than precious metals. So how I'm viewing that, maybe, it's right, wrong, or indifferent, I'm sure you can argue it. I am viewing that we are coming from a very cheap, energy plentiful world, and that the future could be a lot more expensive in terms of energy costs. And I think that the cost curves based off of declining ore grades and the cost of energy is going to push the price of metals higher. So a way that you could play that is, and you're protected from currency risks as well, is I'd rather just take the physical metal, something like a platinum, which is it's one of the most inflation sensitive precious metals, and we're at very low valuations. I'd like to own that out of the system, to diversify out of the system, out of currencies, out of everything, with the least risk way that I could play it. So I view that as kind of like a no-brainer to do if you can store metal somewhere. And the reason is the risk to reward standpoint. The risks are so low with it that I like it that much. Now, if you're starting to play companies, the risks go up dramatically. It's not even close in terms of, the risk of holding a precious metal versus a risk of a company. The company has a lot of risk. You can have supply chain, supply problems. They could be problems with interest rates moving up and they need to borrow money. They've got problems
in South Africa
with taxes. Yeah, the taxes of wherever they're doing it. There's like an infinite amount of risks that you can think of. Your CEO fumbles something. They've got internal cultural fighting. They can't get the service company to do something. There's all these different risks that can potentially happen to your investment there. But it's also got a massive leverage to a price move of, say, natural gas or oil or whatever it is. So your risks are higher, but you're balancing that with the rewards that could be gigantic. So if someone's like, well, how would I play a company versus this is what I do. I evaluate physical platinum and I say, can I beat physical platinum? And how much risk do I have to take on to do it? If I can't really beat it, if I think platinum could go up 4 times to maybe even 10 times, I'm just making up some numbers here. Maybe if it can do a 4x to a 10x, and I'm taking the least amount of risk, why would I take any money and put it into a company? It's really got to go. It's got to be, at least 3, 4, 5 times what platinum can do for me to take on that risk. And there are companies out there that can do 20, 30, 40, 50 times your money. But you have to look at how much risk are you doing, taking on to do that. So the plays that I like the most in any sector that you choose are companies that have infrastructure in place, that are maybe a high cost producer, or maybe whatever they make isn't in favor yet. You start to see the leading indicators or the leading guys start to take off. They could be a large company. It could be like an energy service company. Halliburton, which is a large company, starts to take off, but these little guys, that provides services to services, so to speak. So it's a service company that provides services to the other energy service companies. They're going to lag behind everyone else. So those guys, I can look and I can say, you know what, this could maybe do a 20, 30, 40, 50 times your money. I'm going to throw some money in. I think I'm going to take on the risk, throw some money in it, even though I have physical platinum here that's dirt cheap. Then you also have to look at what's in cycle too. If oil comes in cycle, the precious metals sometimes don't kind of react that quick. They don't like an increasing interest rate environment. So sometimes they lag behind. You could also look at it from the perspective like, well, if oil is going to go back up, you might see precious metals lag a little bit because interest rates are going to want to go up with it. And then maybe you want to get into more energy service or energy or something like that, where the valuations are still incredibly cheap and they might provide a better opportunity for timing wise. So I still diversify out. I still buy assets across different commodities. And I just look at anything that's cheap and has the infrastructure in place where all it is they can generate the cash flow. They just need the right timing. They need that cycle to come back into favor for them. And it's just one big leverage play to that. That's all it is. The companies that are like junior mining companies, I mean, you're going way out there on the risk curve. You're out in no man's land in terms of risk curve. They can't generate cash. I mean, there's nothing they can do. And then, it's tough for them to be a value standpoint because all you're doing is you're basically just speculating. You're hoping that the money rotates into that sector. I know I'm kind of describing the entire uranium sector, and I still have money there because I think it's going to be ridiculous. But you are upping the risk quite a bit, taking on those, we'll call it junior mining companies or junior companies in general that can't produce cash flow. They haven't built the mine. They're sticking, they're actually consuming cash to find out what's down there.
And drilling, hoping to find some good grades or to find something in the drill results.
Yeah. And it's I mean, the risk difference between a junior miner and physical platinum is worlds apart. And I think what happens is everybody's so attracted to the potential returns that a mining company could potentially have if they hit something big, but it's just your payout, your probability is so low that it's a very rough way to play that. So what I would do if I'm running my own portfolio is I would limit my exposure to those and really try to focus on what has infrastructure in place, what is really out of cycle, and if it comes back in cycle, what could that potential return be? It minimizes your risk because if everything's in place, if all the infrastructure is in place, then you're just waiting on the timing then to come back into favor.
Yeah, and it will be a significant reduction in the capex for the company. I'm looking at a few of those as we speak. All right, so that's coming up on the hour mark. Is there anything I missed? Is there anything that you'd like to talk about that we haven't covered before you introduce or educate members on your platinum membership program?
Yeah, the thing I would say is I don't look at the price moves to justify my bullishness or bearishness. What I look at is I do look at ratios, I do look at the market conditions, and I really focus on the housing market to see if the credit is still coming into the system. If the credit's still coming into the system and everything looks good from the sector standpoint, I remain long. I stay long and I just ride out the volatility. I think that's really difficult for people to do because I know when they see something go down 20, 30, 40, 50%, I mean, they're heading for the hills. They're selling everything they got and they just basically sell out. So the hardest thing I think for most investors, especially kind of newer investors, is you have to do opposite of everything else. And you can't use price as the justification to buy something. You have to shift you have to shift the way that you think and do opposite of everyone else, which is incredibly difficult because everybody wants to hide in the herd. It's really hard to be alone thinking for yourself against the herd. So you want to transition from watching prices as a justification for being right or even wrong and start to move to ratios and price and I'll say patterns where things could bottom out and start to turn, and then start looking at all the different sectors because they're all interconnected. If you can kind of make that transition and you're buying patterns, what happens is your risk reward where you buy changes dramatically. What you're using, if a lot of people use price as a justification to buy, it might go up 50 to 100%, but that changes your risk reward if you're already up 100% in a stock, even though people want to chase it and emotionally they want to go after it because they think it's going to continue. It's better to try to buy a bottom, be patient, ride it for a month or two, because when it goes up 100%, you're up 100% then.
Yeah.
And your risk reward is so much different buying at a bottom than it is buying at 100 or 200 or 300% higher than the bottom. And that I think most people struggle with intensely. So what we do with the Platinum membership is I show you my entry points. I show you the charts. I show you the volume when people are buying into it. I show you what I look for. I describe exactly what I'm doing. And you can see me doing it real time. Now, some of these might take some time to play out. They might take 3, 4, 5, 6, 7 months. Because if you're buying a bottom, we're like, okay, this is breaking, but it doesn't mean it has to go higher. Just because something's cheap doesn't mean it has to go higher. It goes higher when money rotates and the market conditions are favorable for it. So we look at that, we know it's coming. And let's say we're 6 months in advance. The markets look and price things in advance of when they actually happen. So you want to buy and get situated in sectors that are very cheap. You know something ahead of us is coming. Let's say higher oil prices where energy service companies are going to go up. Maybe it's energy service companies and the drilling companies, because if the productivity of each well declines, like let's say we're going after worse tier. So you've got tier 1 assets or tier 1 drilling locations. Let's say they're going to go after tier 2 and tier 3. And it's naturally going to progress towards worse and worse returning wells. Well, what happens if you want to keep production up and you're returning less on each well? Well, you're going to drill more. And what happens when you want to drill more? Well, the energy service companies are, 1, going to make more because they're drilling more. And 2, if you need to drill more, that means more demand for a certain amount of rigs. And if you have a certain amount of rigs, you get a shortage of rigs. So you get the supply side of the rigs and all this other stuff gets into a squeeze. And those rigs, some of them, they're kind of hard to build. They're not super fast. So there could be a squeeze in rigs with the lower tier wells. So I look at all that stuff. I kind of make a determination. I'm like, well, the risk reward here is really good because these things are blowing out to the downside. You use your technical analysis. You see me do it. You experience it. And then once you experience it, you're like, wow, that's how it's done. At least the way that I'll say trade, invest. I don't really trade too much. It's more of investments. And you can kind of piece the whole market together. It just takes some time to do it. You won't learn it in one session. You can't learn it in 2 or 3 sessions. I've posted a bunch of training videos as well for technical analysis using fractals, using regular kind of, we'll call it regular technical analysis. There's a bunch of stuff that I have on the website that can really catch you up to speed. And then you can ask me questions directly during the weekend Platinum question and answer sessions.
Perfect. So there you are, guys. Link will be in the description. Company fundamentals, macro, ratio, relative valuations, and technical analysis, all available for Platinum members. Thank you for watching and listening, guys. Stay safe out there in the markets, and hope to see you in the next episode of the ROI channel.